Good morning, all attendees. I wanted to begin by thanking you for choosing this seminar. First of all, on behalf of the North America West Abundant Life Singles Conference, we welcome you to Financial Stewardship, Spiritual Connections, and Gritty Details with Dr. Craig L Israelson. I'm your host. My name is Robert Babb, and my technology-centric co-host and wife, Kimberly Babb, will be joining us. Among all of the presentation choices that you have during this hour, we thank you for choosing this session. We're excited to be able to share this time with you. Before we get started, I'd like to offer a couple of reminders. First, we have muted all attendees, so please post questions for our presenter in the Q&A polling tab on the right-hand side of your screen. We'll do our best to capture your questions and share them during the question and answer portions of the presentation. Lastly, if you do run into any technical difficulties, please contact my wife, your co-host, and she'll try to do the very best that she can do to help you through the chat. In preparations for this session, we were provided a very modest but brief biography from our presenter. However, through my personal research, it has led me to independently incorporate a bunch of professional information so that you can more fully appreciate this renowned researcher, writer, scholar, and presenter. It is now my pleasure of introducing Dr. Craig L Israelson. By way of background, Craig grew up in Los Altos, California, and spent his summers on his grandpa's farm in Logan, Utah. After having met at Utah State University, he married Tammy Trimble Israelson. They now have 7 children: Sarah, Andrew, Heidi, Mark, Nathan, Emma, and Jared. Craig's hobbies include biking, hiking, swimming, woodworking, traveling, and family vacations. He has competed in the Boston Marathon an amazing 5 times, but he's still looking for that first elusive victory. In academics, he holds a PhD in Family Resource Management from Brigham Young University and a BS in Agribusiness and an MS in Agricultural Economics from Utah State University. Craig taught at Brigham Young University for 9 years and at the University of Missouri-Columbia for another 14. He now teaches as an executive in residence at Utah Valley University in the Personal Financial Planning program. Primary among his research interests is the analysis of mutual funds and the design of investment portfolios. Craig is the developer of the 7-12 portfolio and the author of 4 books. He writes for Barron's and Financial Planning magazine and is a regular contributor to various online websites. His research has been published in the Journal of Financial Planning, Journal of Asset Management, Journal of Performance Measurement, Asia Financial Planning Journal, Journal of Family and Economic Issues, and Financial Counseling and Planning. His research has been cited in the Christian Science Monitor, Wall Street Journal, Newsweek, Smart Money Magazine, Forbes, Kiplinger Retirement Report, Advisor Perspectives, Dow Jones Market Watch, Family Circle Magazine, and Bottom Line Personnel. I can't hear. Can you help me? Hey, Craig. Apparently they're not able to hear right now.
Okay.
Figure out why. Can you hear now? Kim, could you check in the chat to see if they can hear me? Yes? All right. Hey, to all of our friends out there, we want to let you know technology is an imperfect thing, and so are the people operating it. So we apologize for that, but we're going to give this another shot. So let's go ahead and begin. Hey, I wanted to welcome you, first of all, to the North America West Abundant Life Singles Conference. You know, we welcome you to Financial Stewardship, Spiritual Connections, and Gritty Details with Dr. Craig L Israelson. I'm your host, Robert Babb, with my technology-centered co-host and wife, Kimberly Babb. Amongst all of the presentation choices that you have during this hour, we thank you for choosing this session. We are excited to share this time with each of you. But before we get started, I need to offer a couple of reminders. First, We have muted all attendees, so please post your questions for our presenter in the question and answer polling tab on the right side of your screen. We'll do our best to capture your questions and share them during the question and answers portion of the presentation. And as you have already learned, you have been able to deal with technical difficulties through using the chat option. So thank you for doing that and continue to do that. It is now my pleasure of introducing Dr. Craig L Israelson. Craig grew up in Los Altos, California, and he spent his summers on his grandfather's farm in Logan, Utah. After having met at Utah State University, he married Tammy Trimble Israelson. They have 7 children: Sarah, Andrew, Heidi, Mark, Nathan, Emma, and Jared. Craig's hobbies include biking, hiking, swimming, woodworking, traveling, and family vacations. He has competed in the Boston Marathon an amazing 5 times, but is still looking for that elusive first victory. In academics, he holds a PhD in Family Resource Management from Brigham Young University, a BS in Agribusiness, and an MS in Agricultural Economics from Utah State University. Craig taught at Brigham Young University for 9 years and the University of Missouri-Columbia for an additional 14. He now teaches as an executive in residence at Utah Valley University in the Personal Finance Planning program. Primary among his research interests is the analysis of mutual funds and the design of investment portfolios. Craig is the developer of the 712 portfolio and the author of 4 books. He writes for Barron's and Financial Planning magazine, and is a regular contributor to various online websites. His research has been published in the Journal of Financial Planning, Journal of Asset Management, Journal of Performance Management, Asia Financial Planning Journal, Journal of Family and Economic Issues, and Financial Counseling and Planning. His research has even been cited in the Christian Science Monitor, Wall Street Journal, Newsweek, Smart Money Magazine, Forbes, Kiplinger Retirement Report, Advisor Perspectives, Dow Jones Market Watch, Family Circle Magazine, and Bottom Line Personal. Over the past decade alone, he has traveled extensively, presenting in 25 different US states, as well as in Australia, Canada, China, Indonesia, Japan, and even on Norwegian cruise lines, if we could all be so lucky. It is now my distinct pleasure to turn the balance of this presentation time over to Craig.
Thanks, Rob and Kimberly. Appreciate. Can you hear me okay? Okay. Let me share my screen. All right. Are people seeing the first slide? Is that working? I'm going to assume that we are okay. Let me just double check if I'm getting any feedback from. Yes, it's working. Okay. Well, let's try that again. Okay. Financial stewardship is our topic today. And I've chosen the word stewardship intentionally because it implies that we don't necessarily own everything. We're the caretakers of much of the resources in our mortal experience. So a big overview of what we're going to talk about today. Number one, there are connections between mortal tasks, what I'm going to call chores, and the development of eternal attributes. This is kind of the why behind the what. If we have a why, it's much easier to persist and continue. Secondly, an introduction to investing. And third, the gritty details, some of the gritty details of investing. So that's kind of our map for today. So we'll start with just a couple of thoughts regarding the connections between our chores and the development of eternal attributes. And I think of this as mortal tasks with eternal consequences. In other words, that our mortal life has meaning, and that the meaning carries very profoundly through the veil. Our first big observation, at least for me, is that we're here to become like our heavenly parents and to develop the attributes they possess. And that's the main. There's an NBA coach who has a saying. I don't know if he made it up or I heard it from him, but it goes like this: the main thing is to keep the main thing the main thing. And I just love that. The main thing is to keep the main thing the main thing. And this realization that we are here on this planet created for us to grow and become like our heavenly parents. So an obvious question is, how do we do that? And I would suggest that it's not rocket science. It's by doing our chores, our daily tasks, over and over again. Think about the story of Ammon, the great missionary Ammon. And what many choose to focus on is that heroic defense of the king's flocks, sheep, by the waters of Sebus. And he pretty much single-handedly defended the flock against a number of marauders. And when this was recounted to the king was, quote, astonished. And then he asks, where is this man? And they said, well, he's taking care of the horses, like he was, he's in the barn, basically, taking care of the horses. And the king was, quote, more astonished because of the attention to the chores that he has been. Ammon was faithful in the small things, taking care of the horses, working in the barn after this great Hollywood moment by the waters of Sebus. That's really one of my points, is that these what may seem like mundane day-to-day chores are how we build character. Because our chores allow us to experience endurance, persistence, compassion, charity, forgiveness. These attributes are the attributes of eternity. These are the attributes that we seek. So, some examples of these mortal chores would be caring for our bodies, our personal hygiene, caring for others around us, caring for resources that have been entrusted to us as a steward, talents that have been entrusted to us, opportunities that have been entrusted to us. These are some of what I call the chores. And our focus today will be on some of our financial chores, our money chores, what I refer to as financial stewardship. I love this quote by Elder Maxwell, Neil A. Maxwell. He describes the purpose of mortality this way. Our first estate, quote, our first estate featured learning of a cognitive type. The second estate, however, is one that emphasizes experiential learning through applying, proving, and testing. We have moved, as it were, from first estate theory to second estate laboratory. And that's from the book, All These Things Shall Give the Experience. So first estate theory, that was the pre-mortal existence. And we learned, I believe we learned quite a bit about our eternal path. And we recognize that this class came with a lab, and this lab is on this planet. And here we are in the laboratory portion of our degree. Stewardship of our financial resources in this, quote, second estate laboratory experience helps us learn the virtues of prioritizing, balancing, sacrificing, and consecrating. Think of budgeting as financial stewardship prioritizing. Think of budgeting as balancing, learning how to balance. And balance isn't always equal. Think about an orchestra. An orchestra does not have 20 tubas. There may be one tuba and 20 or 30 violins. And yet the sound is balanced, even though it's not technically quantitatively balanced. And that's an interesting aspect of our financial stewardship, is that not everything will always be numerically or quantitatively balanced. It might be balanced in even more important ways, such as the example of an orchestra. And I call that harmonic balance as opposed to accounting balance. Financial stewardship, when we view it in this way, is not a burden, but rather a necessary tutorial in becoming more patient, more focused, more aware, more enduring, more self-reliant. Stewardship of the financial aspects of our lives, either as an individual or in a family, is an effective second estate laboratory for learning virtues that are valuable on this earth, such as our temporal talents, as well as in the eternities, the spiritual characteristics that we seek. That is truly, that's the main, keeping the main thing, is focusing on what do these chores, what are they building within us? And to not lose sight of that. Consider this: money and wealth do not move with us through the veil, yet the attributes attained through the righteous use of such resources are a permanent part of us. Attributes that we attain through financial stewardship, they stay with us. That's by far the more important aspect of our financial stewardship, as opposed to our account balance. We're really trying to focus on the balance in our personal spiritual growth account. So temporal tasks that facilitate the development of spiritual characteristics such as patience, prioritizing, gratitude, self-mastery, self-reliance, and endurance are portable and needed beyond the grave. That all said, this is not a smooth path. It was certainly not a smooth path for the Savior. He experienced a lot of pushback, a lot of challenges in his brief mortal life. So we have to recognize and accept the fact that we're going to experience frustration as we move forward. And that means something real is happening. If it's super easy, there's probably not a lot of growth happening. So I would introduce a principle to you, and I've highlighted the 4 key letters. We should not make important decisions, and in this context, financial decisions, if we are hungry, angry, lonely, or tired. And that's referred to as the HALT principle. If we are hungry, angry, lonely, or tired, or if we're all of those, we need to put ourselves in a little time out. We need to get something to eat. We need to consider why we're angry. We need to reach out to someone who we love and who loves us. And if we're tired, we just need to take a little nap before we make potentially a decision that has really destructive consequences. Think about the potential decisions a person might make if they're really lonely. And there can be some powerful, just that one, that loneliness can lead to some actions and behaviors that don't represent our best. And I would also suggest that a crisis of faith, what's been described as a crisis of faith or a crisis of confidence, may simply be a symptom of being tired or angry. And as it pertains to financial stewardship, a crisis, a financial crisis, can sometimes bleed into our confidence in other areas. or it creates a lack of confidence. And we have to be careful to put boundaries around a crisis or a problem. And that problem pertains to this one thing. It's not a global problem necessarily. Okay, so that introduces what I think is the most important aspect of what we're here talking about today, is the spiritual why of the what, of the mechanics of financial stewardship. This is the spiritual engine that fuels us when we're tired of doing our chores. I'd like to now transition into an introduction, just a little primer to some basic ideas of investing. And I can summarize it really in two headline quotes. Number one, set a goal to save 10% of our income. And secondly, build a diversified investment portfolio. Even if you're 60 years old, I'm 62, I still have a diversified investment portfolio. If you're 22, you have a diversified investment portfolio. It's a lifelong approach to preserving and growing resources that are needed to pay for missions, pay for whatever. So let me give you an idea of the power of starting this process as early as you can. So perhaps some of you were alive in 1970. I was 11 years old. Let's say you started investing and you were making, I'm just pulling a number out of the air. You made $35,000, which was a really good salary in 1970. And you get a 3% increase in pay over the next 51 years to bring it up to 2021. So that's 51-year period in which you were investing 10% of your income right here. You save 10% of your income each year. If you simply put that 10% of your income into a bucket in your room and it earned zero interest, you had about $410,000, which, that's approaching $500,000. That's pretty impressive. If you put that 10% of your income into a savings account, earning what we call a cash rate of return, which averages of just under 5, that average is about 4.8% since 1970. Understandably, in more recent years, the return in a savings account is pretty close to zero, but there have been some years where it's been 8, 9, 10%. Well, so if you were very risk averse, very conservative, you had accumulated $905,000. If you built a diversified investment portfolio with stocks, bonds, cash, real estate, commodities, just a variety of what we call asset classes, a variety of ingredients, you had about 4.6 million. So that really illustrates why we build an investment portfolio that is diversified across a number of sectors, is because of the dramatic growth potential. So one way to think about an investment portfolio is that we're making salsa. And when you make salsa, as you can see in the image, you've got onions and tomatoes and peppers and cilantro and onions and garlic and so forth. These are very different ingredients. It would be pretty hard to mistake a tomato for cilantro. They're very easily distinguished as being different from each other. And that's the whole point of salsa. We're blending together things that are very different. And the combination, the ultimate combination, is really what we're after. Some of the ingredients we may not want to eat just by themselves. Most people don't, ram a bunch of cilantro into their mouth and start chewing. And if you do, that's fine, but that's not super typical. So the corollary is that there might be some things in our investment portfolio that wouldn't represent an ideal investment just by itself, but as a component, as an ingredient, as a teammate, it's actually quite helpful. And that's an important realization, that we have to focus on the end result and not get too wrapped around the axle on the individual attributes of each individual component. And all I'm trying to say here is that some investments, they behave differently year to year. They have a good year, they have a bad year. And we have to look at the ingredients of a portfolio and say, okay, do these ingredients have good years and bad years at different times? Don't focus on the bad year, focus on the timing of when they have good and bad years. And that's really kind of the salsa metaphor. Otherwise, we can become too myopic in our evaluation of the individual components and start to microanalyze ourselves out of a well thought out portfolio. So most people use mutual funds to build their investment portfolios. So the question is, for those who are not familiar with this topic, what is a mutual fund? Well, a mutual fund is kind of like this. We probably have all seen these. We loved these as kids. This is a mutual fund of cereals. In other words, we have a bunch of different kinds of cereal, and then they're shrink wrapped together. So use this idea and compare it to the actual mutual fund. So Frosted Flakes is actually Delta Airlines stock. So this mutual fund, the shrink wrapped package, has X number of shares of Delta Airlines in the package, in the portfolio. And Apple stock is, of course, Apple Jacks. And let's say that John Deere is Fruit Loops. Okay. And then the other boxes are other companies, Amazon, whatever it might be. This represents a diversified, what we call mutual fund. And that is the easiest way to think about it. You invest into the mutual fund, and you are investing into each of these companies with your $10 investment or your $20 investment. You're tapping into a diversified portfolio that's been built for you. It becomes a very efficient way to invest. So now let's take it one more dimension, and that would be, what if each box, each cereal box, each individual box is a mutual fund? So in other words, the Apple Jacks is a US stock mutual fund. And in that US stock mutual fund are a bunch of different US companies. So now we have a real estate mutual fund. We have an international stock mutual fund. We have an international bond mutual fund. So now we have a portfolio we have a diversified portfolio of diversified mutual funds. Now we're really getting into the notion of broad diversification. And this is really where we're going in our understanding of what it means to diversify. So we still need a recipe. If we're going to make salsa, if we're going to shrink wrap cereal boxes together, we need some sort of a game plan or a recipe. So here's a visual way to think about what a portfolio might look like. This is a classic pie chart. So in this section, this slice of the pie would be large US stocks. You invest in large US companies. Well, you would do that through a large US stock mutual fund, a mutual fund that focuses on companies in the US. And they're large companies, meaning they're household names: Apple, Facebook, Amazon, Eli Lilly, just a number of companies. These are well-known, established firms. Then you would have another mutual fund that focuses on small US companies, another mutual fund that focuses on non-US stocks like Toyota, Another that focuses on real estate. And this one can be kind of confusing to people. They think, well, I already have a home, so I have real estate investment. Generally speaking, a real estate mutual fund is investing in what's called commercial real estate, meaning hotels, malls, non-residential. Commodities is another type of mutual fund that invests in oil and grains and meat, cattle, and so forth. And that type of mutual fund can be very helpful during times of inflation, which we haven't had much of in recent years, but we will inevitably face periods of time over the course of time where inflation cycles up and cycles down. And when inflation is ramping up, it's usually because commodity prices are going up. So commodity prices, a commodity mutual fund doing well usually is a manifestation that we are in an inflationary period. And then a couple of mutual funds that focus on things that are not stocks. Now, commodities aren't stocks either. They're what we call futures contracts that trade in Chicago. But large stock, small stock, non-US stock, and real estate, those are called real estate investment trusts, and you can think of that as a stock. But commodities, bonds, and cash are very different. And bonds is what we call a fixed income and investment, meaning it pays an interest rate to the person who buys the bond. Well, there are mutual funds that focus on bonds. They just buy hundreds or thousands of bonds, and then you receive a portion of that interest that the bond pays out. And then a cash fund, which is basically a mutual fund that is kind of like a savings account. So that's an example of a recipe of a diversified portfolio. And if you think back to this little box we looked at a few slides ago, that $4.63 million growth figure, guess what? That came from this recipe. That's the recipe that produced that 4.6 million, a diversified collection of mutual funds. Now, how has that kind of portfolio performed over the last 51 years? From 1970 to 2020 is actually 51 years because you have to count the start and the end year. So it looks weird to say 51, but it is 51. So each purple or maroon bar is the return, the percentage return that year. So in 1970, the return was about 4% or so. Then in 1971, it was about 16 or 17%. And as you're looking at this, it's kind of an interesting experience in human behavior. What did your eye focus on? Did it focus on all of the up years, or did you kind of zero in on this really bad year? And not that that reveals the inner workings of our soul, but consider that 86% of the time, the year-to-year returns were positive, above zero. And that this year right here, which is 2008, many of you probably guessed that without even looking at the x-axis, that was a particularly rough year. And yet it's in the minority. Well, it's absolutely the outlier in terms of the magnitude of the loss. So the portfolio lost about 27% as a portfolio. But cash in that year had a positive return. Bonds had a positive return. So you had some components, even in 2008, that had positive returns in that year. The 9.5% average, which is what the average has been over the last half century, is very impressive. But look at the average in contrast to the year-to-year returns. The year-to-year experience, you don't have many years where you actually get the average return. You had one here, you get the idea. In other words, that variation around the average is what we call the standard deviation. You may remember that from a stats class. in school. Just think of it as the swing from side to side of the bell curve. And we have to be able to live with that. Now, obviously, when the return is above average, most people aren't too concerned with that. It's usually when it's below average or negative that it kind of bothers them. But I will tell you that successful investors are patient, and that patience is an eternal attribute. And so it's kind of interesting that as we become a better investor, we're actually growing money to the extent that that's important, but we're also growing attributes, which I think is more important. Now, let me just stop there for a moment. Are there questions that have popped up at this point?
There are not questions at this point.
Okay, very good. Let's press on. So obviously, how do I start? How do I get going? This is all talk until we turn the key. Well, what we're looking for are ingredients to make salsa. So where do I find tomatoes, metaphorically speaking? Where do I find onions and so forth? Where do I find these mutual funds that I put together in a broadly diversified portfolio of X number of mutual funds, 5 or 6 or 7 or whatever number of mutual funds? Well, we've got Vanguard. Vanguard is a mutual fund company back in Pennsylvania, very well known for low cost. The cost of their mutual funds is very low each year. We've got Fidelity Mutual Funds in Boston. A couple of years ago, they lowered their minimums to open an account in their mutual funds down to 0. It was a very interesting move. Vanguard's minimum tends to be around 3,000 per fund. Some are 1,000. And so Fidelity, I suspect, wanted to introduce that 0 minimum to their competitive advantage, perhaps. Schwab Mutual Funds in San Francisco, a very excellent company on the West Coast that has a number of exchange traded funds as well, and we'll talk about exchange traded funds in just a moment. And then Homestead Funds. Homestead Funds is a neat company. It's a small company in Virginia, and they have a $1 minimum to open an account. So that used to be really, really unusual until Fidelity went to their 0 minimum. But Homestead Funds is a much smaller mutual fund company, and not as well known as these other 3, but they have some excellent mutual funds and worth considering. So let me show you an example portfolio using 5 Vanguard funds. And these 5 funds are the Vanguard Federal Money Market, which is 100% cash. Excuse me. There's no stock, there's no bonds. And each mutual fund has a ticker symbol. And just as a little interesting fine point, mutual funds always end in X. The ticker symbol always has to end with an X. Whereas an ETF, an exchange traded fund, often doesn't end in X, most often doesn't. And there are only 3 letters. They can be 4. Whereas a mutual fund is 5 letters and always ends in an X. So that's one mutual fund right there, the Vanguard Federal Money Market Fund, 100% cash, so it's very, very conservative. Has a lower expected return. Then we have the Vanguard Wellesley Income, and there's its ticker symbol, BWINX. And that is a fund that has an overall composition of 40% in stocks and 60% in bonds. And the minimum investment for that is $3,000, as it is for the Federal Money Market Fund. Then we have the Vanguard Star Fund, which is a very interesting fund. It's a fund of funds. In other words, it's not just a collection of companies and bonds, it's a collection of other mutual funds. It's a mutual fund of mutual funds. And it's actually 11 other Vanguard mutual funds. It has a 60-40 ratio, 60% stock, 40% bonds. It has a $1,000 initial investment, so it's a very friendly fund for people that have only a modest amount of money to invest. And then we have two additional, what we call sector funds. They are sectors of the US stock market. We have the Vanguard Healthcare Etf. And like I mentioned, ETF stands for Exchange Traded Fund. So it's a mutual fund that trades like a stock, meaning it trades during the day. You can buy and sell an ETF during the day, whereas a mutual fund, you can only buy and sell at the end of the day. After the market is closed, then that transaction takes place. So exchange traded funds are more nimble for you as a trader. If you're going to be trading things, they're more nimble than a mutual fund. Other than that, their attributes are really essentially identical. And so that ticker symbol is VHT. That's 100% stock, and those stocks are in the healthcare industry, the healthcare sector. And ETFs don't have a minimum investment other than the price of the ETF itself, the share price. Because these are sold, mutual funds are sold in shares, just like stocks are sold in shares. So there's no stated minimum. But if the price of VHT is $120, then that means you have to have $120 to buy one share of that ETF. And then the last ingredient in this recipe is Vanguard Information Technology, also an ETF, 100% stock. And the managers of that ETF focus on companies in the information technology arena. And so that could be a Micron, a chip company. It could be a software company. It could be IBM. It could be Dell. Just anything pertaining to information technology. Amazon could clearly fit in that category. So that's the shopping list for. Those are 5 out of. Vanguard has hundreds of mutual funds, and I've just chosen 5 to give you a sense of what a shopping list would look like to build a portfolio. And so if you wanted to build a conservative portfolio, you could, for example, use only 3 of these ingredients. This is a mild salsa. We have mild, medium, hot, and so forth. So you'd have 30% of your investment in the federal money market fund, 40% in the Wellesley income, and 30% in the STAR fund. Alternatively, if you want to dial up and the conservative portfolio has about 1/3 of its investments in stock and 2/3 in bonds. And that's a fairly conservative mix. A moderate portfolio, you have these allocations to each of the 5 funds. And so if you just think of it in terms of $100, then $20 in the moderate model would go into the money market fund, $30 would go into the Wellesley income, and so forth. Obviously, with the minimums as they are, that's going to take more than $100 to start that portfolio. And that portfolio is just under a 50-50. So it's 45% stock overall and 55% in bonds. And then a more aggressive, I call this a moderately aggressive portfolio. You see the allocations there, and that's a 60-40, 60% stock, 40% bond. That's kind of a classic mix for a lot of people. They want to lean more toward the stocks because you have a little bit better, higher expected return over time. And when I say over time, a stock investor needs to be thinking in terms of 10, 20, 30 years. I know with the advent of online trading platforms that it's easy for people to think that long term is 3 months. That's not the case when we're buying stocks and building portfolios like this. A time frame that's much more relevant would be 10 to 15 years before we don't want to react to what happened in 3 months. That's like walking into the nursery at church. One child is crying, and you think, oh my goodness, that child's going to be a horrible adult, because we just completely extrapolate a brief behavior in the nursery to the rest of their life. And unfortunately, investors that don't have a long-term perspective can behave kind of that way, where they extrapolate something in the moment, make a decision. Maybe they're angry, hungry, angry, lonely, tired. Maybe they're angry with what happened, and so they just blow up their portfolio. They sell everything at a really, really wrong time. Now, with that set of information, are there questions?
Yes, we do have a question. So can we get more information on digital and cryptocurrency?
Digital and cryptocurrency is, the jury is still out if that is a bona fide asset class. When I say asset class, let me just scroll back up here a little bit. When we think of asset classes, we're thinking of these right here. These are well-established asset classes that have indexes, well-known indexes. For example, the large US stocks, there's a number of indexes that represent or give you a measure of how that sector is doing. The most notable would be the Standard & Poor's 500, the S&P 500. That's an index that allows us to get a sense of how that portion of the US stock market's doing. All of these asset classes, the small stocks, that could be the Russell 2000 index or the Standard & Poor's Small Cap 600 index. Cryptocurrency is evolving, and until there is an established sense of an index and the appropriateness of that particular type of investment, it still is kind of in its infancy. And so I'm not including it in sort of an introductory type of portfolio. But certainly if a person has an interest in it, there are ETFs that focus on cryptocurrency, exchange traded funds. And there are, of course, individual companies that represent cryptocurrency. So good question, but probably beyond the scope of what we're talking about here.
All right, a couple more questions. What are your thoughts on getting started through online apps such as Acorn or Stash?
Yeah, Acorn's an interesting one. What I know regarding that is that I think it rounds up when you make a credit card purchase, if I'm keeping straight these different applications. So if you spend $5.80 on your credit card, it rounds up to 6 and puts that 20 cents from 580 up to 6, that 20 cents into an investment account. And by the way, that investment account looks pretty similar to this pie chart that I just showed you, that diversified portfolio approach. I think that's a wonderful way to dip your toe in the water. I've had students do research on that. You know, would that approach be adequate over the course of my life? And the consistent findings are, no, it won't be adequate, but it certainly, it helps. But your investment platforms will need to be beyond that. I'll get to it in a second. Your 401k through your employer, an IRA account on your own. To get started with Acorns, yeah, no reason not to. But it would be incorrect to say that will be adequate over the course of your life, because it won't be. To accumulate the resources you'll likely need.
All right, next question. If I'm ready to buy a house now, should I wait until the market calms down or buy now while interest rates are low?
Yes, a classic dilemma. When money is cheap, like it is now, when interest rates are low, we call that cheap money. Generally, what can happen is that the price of a home will go up just because money is cheap. I mean, the seller knows, everybody knows money is cheap. That's no secret to anybody. And so the seller of a home knows that if the borrower can borrow more, and so they'll naturally probably let the price drift up, or ask more for the home. So there is that relationship of house price and interest rates. Additionally, we have, at least in the Utah market and Idaho, a lot of pressure on the real estate market, and prices have gone up dramatically. I don't know if there's a safe way to answer your question. All I can say to you is, if I were in the market to buy a home right now, I think I would wait, because we really are looking at prices for homes that, to me, just seems ridiculous. Could they go up? They probably could. Could they go down? They absolutely could. We've seen this. This is not our first rodeo. And like any market, it can fluctuate. And the real estate market is a market, meaning prices go up and go down. My impression would be to wait a little bit if you have that luxury.
Okay, last question. Would you say something about changing strategy as we age, 70 being different from 25?
Yeah, great question. And that really is embedded in this right here. So at the age of 25, you would be in the moderately aggressive, or even more aggressive. You might have an 80-20, 80% stock, 20% bond allocation. And as you age, and it isn't always age related, it could be life circumstance related. So I don't want to link it just to age, but generally over time, many people move from right to left. They move from moderately aggressive, or aggressive over here, to moderately, to moderate, to conservative over time. And that's probably the easiest way to think about it. And that's why we have a variety of recipes, is that it facilitates that sort of migration to a somewhat more conservative portfolio over time. But you'll notice that the conservative portfolio is still 1/3 in stock. So if a person retires at the age of 70, they still could feasibly live 20 years. And you can look at your own genetic base and see what might be an expectation there. And 20 years is still a long term. You're still a long-term investor, but you don't want to experience the volatility of a moderately aggressive portfolio. So I think this sort of approach that you're looking at would be a good guide to what you're asking. Any other questions?
That was it. Thank you.
You're welcome. So in our remaining time, let me just go through the performance of some of these individual, what we call portfolio building blocks, these 5 funds that I've highlighted. So here's the money market account. It's basically cash. Here's the returns year to year to year from 2006 through 2020. So we're back in 06, the return was 4.8%. Last year in 2020, it was under a 0.5% return. So the 15-year annualized return is 1.21. And that's a geometric mean, not an arithmetic mean. That's an important distinction that we don't have to go into now, but that's the geometric growth of money. So in 2013, for example, I just picked that year arbitrarily, the return of the cash fund was 0.02%, basically zero. The Vanguard Wellesley income was 9.27% return in that year. So if you started with $100, you finished with $109.27. That's what that 9.27%, that's a percentage return. The Vanguard Star Fund had a 17.8% return. The Healthcare ETF had a 42% return. And the Technology ETF had almost a 31% return. So where you see reds, that's a negative return. You'll very rarely, if ever, see a red in a money market instrument, but you won't see 40% either, and that's the trade-off. And those are the 15-year numbers. And then the portfolios, the conservative, the moderate, and the moderately aggressive, you had a 9% return in that same year of 2013. The moderate model, 13.5, and the moderately aggressive, 18.1. And in terms of a 15-year average, the conservative over the last 15 years has averaged just under 6% return per year. 7.2 is the average for the moderate model, and 8.5 for the moderately aggressive, just to give you a ballpark of what kind of expectations you might have over longer time frames. Now, just real quick, as you go to set up an investment account, you have to consider what type of account you want to set up. And so if you went to Vanguard or to Fidelity or to Schwab or to Homestead or wherever you go, you can set up a regular investment account, meaning you can put any amount of money you want in at any time and take out any amount of money you want at any time. Because of that, you have no tax protection, meaning when you put money in and take it out, that's either a capital gain or a capital loss or a wash. You have no tax protection. Taxes are not deferred. You have to pay taxes on gains every year when you make sales. Alternatively, you can set up an individual retirement account, and those contributions lower your income in that year. And so you lower your taxes in that year. And then the money grows tax deferred, which is wonderful. When you take the money out when you're retired, that's when you pay taxes on it as ordinary income. And for those who are under 50 years of age, you can put in $6,000 a year. That's the maximum you can put in, where there is no maximum if it's a regular investment account. Those who are over 50, I believe they can put in $7,000 a year. They have an extra $1,000 they can put in. Or you can do a Roth IRA, and that money you put in does not lower your income. So you don't lower your federal income taxes, but the growth of the money is tax exempt. You don't pay taxes on it when you take it out. That's a very nice feature. The other is a 401k, and that's with your employer. And you would want to do a 401k if the employer contributes anything toward your contribution. So if they make if you put in $100 and they put in 50, well, that's fantastic. If you put in 100 and they put in 100, well, that's more fantastic. And so you really want to consider the 401k with your employer. And when you set that 401k up, you'll want to build a diversified portfolio, and they'll tell you which mutual funds are at your disposal. For those who are new to investing, I would encourage you to focus on the 401k if you work for a company, if you aren't already, or a Roth IRA. Those two would be probably your first areas of focus in what types of accounts you set up. You'll be using mutual funds in all of these. All of these accounts use mutual funds as the underlying investment. The question is, what type of account are you setting up to make the investments into a mutual fund? For those who would like to download it, I've included a little Amazon book that I wrote called Start Investing Now. It's on my webpage with this conference. So if you go to the conference and go to the speaker, it's one of the files you can download. Also, this slide deck is also downloadable if you want that to review it. If you want me to email it to you, if you'll just email me at craig@712portfolio.com, I'm happy to send you a PDF of this book, and it'll go through some of the things we talked about today and some additional information as well. I'm happy to offer it to you at no cost. That is something I'm pleased to do. Were there other questions that popped up?
I think you've addressed them. Thank you so much.
You're very welcome. And if anyone attending has questions as you go forward over the next week or two or year or two, there's my email. I'm happy to field questions. I may not have the answer, but I may be able to help you, help direct you toward an answer. This is what I do for a living, and I appreciate the chance to help, just like each of you help others. This is one way I can help. I think we've reached the magic hour of 12, and so I appreciate your spending your time with me today, and I leave my blessing on you.
Well, thank you, Craig, for your time, attention, and your expertise in being able to help each one of us to learn more about the interrelationship between spiritual connections and the details of investing. We want to also acknowledge what makes these sessions so valuable is the fact that you have questions and that you make it interactive. We do want to also acknowledge there were a number of questions we couldn't get to, and so please follow up with Dr. Israelson and his very gracious invitation to be able to field questions after the conclusion of this session. So we would just simply like to say, as a final reminder, please make sure to check your conference agendas so that you don't miss any of the wonderful things that are planned for the rest of your day today. So from our home and our hearts in Vancouver, Washington, and on behalf of Dr. Israelson, please have a wonderful day at your conference and have a great conference weekend. Bye-bye.